Welcome to the latest episode of Quest for Twice. Today is March 23rd. This year, the stock market has not been performing well with some significant pullbacks until the large rebound last week. The key question I'm going to discuss today is if the market going to crash. People argue for that often recite the PE ratio. So currently the S&P 500 forward PE is about 20. Then that's fairly high compared to historical average. The market looks even more expensive if we use the Shiller Cape PE. So today I'm going to make an argument against crash by looking at the three tech giants. So these three tech giants are Microsoft, Google, and Amazon.com. Together, they are about 14% of S&P 500 total cap. I'm now going to discuss Apple and Tesla, despite that combined they are 9% of the market. But I think they are overvalued, so they are not going to augment my case against the crash. Let me first take a look at Amazon.com. This chart shows the revenue of Amazon.com in the last 12 years. And also, I plotted the gross margin of Amazon. One thing I immediately notice is how consistent the Amazon's revenue growth has been comparing to the exponential curve I feed it. The 2020 revenue was above trend mostly because of the pandemic impact. But still, in the grand scheme of things, the revenue growth has been very consistent. What's even more remarkable is the consistent gross margin expansion. So 10 years ago, the gross margin was about 22%. Then it gradually increased. And nowadays, it stands above 40%. And with the chance even moving higher in 2021. So what drove the gross margin expansion? The answers are mostly AWS, plus advertisement and subscription. Those are very high margin revenues. So if we put those two things together, Amazon is making more and more sales each year. And from each dollar of sale is getting a bigger cut to flow to its gross profit, which is used to pay for long-term investment. That is a truly remarkable business. This chart shows the Microsoft revenue and the gross margin in the last 12 years. It's also remarkable, but in a different way. Microsoft can be considered as two different companies before and after 2014. If we look at 2014 and the years before that, its revenue was growing steadily, but not super fast. And its gross margin was high to begin with, then declined, and reached the bottom around 2015 and 2016. Then from 2016 onwards, its revenue just took off and grew much faster than the years before 2014, with stable gross margin and even slight expansion in the recent years. So what happened? The answer is the new CEO took over in 2014, so it has transformed Microsoft from a PC-based company to a company that focuses on the cloud. So the fast revenue growth since 2016 was driven by three key factors. One is the Microsoft Azure, which is a hybrid cloud service. Another one is a software as a service. So that's a software residing in the cloud, and that includes the classic Office 365, but also other software. Another key growth driver in recent years is the gaming in the cloud. So all those three key drivers are somewhat related to the cloud. Apparently, that strategy was very successful and drove very fast revenue growth. The last tech giant is Google. So this chart shows the revenue and the gross margin for Google in the last 10 years. Google's revenue is driven by advertisement sales. So that's more sensitive to the economy. As a result, the revenue fluctuates more compared to the trend. For example, in 2020, the revenue was below trend, and 2021 was above trend. These are the effects of the pandemic. And 2021, the economy reopened, so there was more demand for advertisement. So if we neglect the impact of a pandemic on 2020, the Google's gross margin has been relatively stable around 60%. In recent years, it's below 60%. That's most likely because Google has been playing a catch-up game in its Google Cloud service. So comparing to Amazon and Microsoft, Google Cloud is not as large and doesn't enjoy the same level of economy of scale. However, that's also potentially a growth driver in the next several years, and that'll help Google to be less dependent on advertisement and also dependent on the economy in general by extension. So why have these three companies been able to grow so fast in the last several years? And will the fast growth continue? Then we can address these questions by looking at those companies' investment and return on invested capital. So on the left, that's the comparison of return on invested capital before tax for those three companies. I did not include the non-operating income, which is conservative and make the ROIC less than the actual numbers. So the white lines is Amazon.com's ROIC. So what's really remarkable is how consistent the return rate has been in the last several years. It's always hovers between 13 and 14%, extremely consistent. For Google, that's the yellow line. That's still fairly consistent with average around 23-24%. Obviously, the return was lower in 2020 because of the pandemic and had a big bounce in 2021. I think that's because of the economy reopening and should normalize in the coming years around 23-24%. What's really remarkable in a different way is Microsoft, because its ROIC has been steadily increasing in the last several years. So after the new CEO took over, the return was about 13%. Then it just gradually trend up. Now in 2021, it reached 28%, which is a historical high. So for Microsoft, each dollar it invested is making a higher return in the subsequent years. Compared to Google and Amazon, they have a consistent return which are high, but they are steady over the years. So if we look at the ROIC, Microsoft is definitely the best company among the three. However, the whole picture is not so simple because ROIC is a ratio on investment. The denominator is the total amount of investment each company has been making. Let's look at the other half of the entire picture on the right. So in this graph, I plotted the total invested capital at the end of each year in the last 8 years. Just to be clear, the numbers are not the investment each company made in that year. The numbers are the total investment the each company has on their book with the adjustment for investment in R&D and marketing, and also with the deduction from depreciation and amortization. So in 2014, Microsoft has the most invested capital. Amazon has the least. Google was in between. And now, fast forward by 7 years. At the end of 2021, Amazon has the most invested capital, and Microsoft has the least, and Google is in between. If we look at the rate of increase, the amount of Amazon has been making is truly remarkable because it has been much higher than the other two companies. Just to be clear, the other two companies have been making a lot of investment. For example, Google's investment in 2014 was around 100 billion. Now, at the end of 2021, it stands at 400 billion. So that's quadrupled. That's a huge amount of increase in 7 years. But for Amazon, the rate of increase is just so remarkable, so large. So despite its return on invested capital is almost 10 percentage points lower compared to Google and Microsoft in 2020-2021. Its revenue growth has been extremely fast because of the large amount of investment Amazon has been making. Therefore, it's hard to say which company is better in terms of growing its business. Microsoft seems to be focusing on high margin business. As a result, the investment opportunities are fewer. And Amazon has been less selective in the best opportunities it invests in. But it has been investing so much that even at a lower return rate, it still drove very fast revenue and income growth. And Google is in between. So all three companies are fantastic business. So one cannot go wrong by owning any of the three businesses. The differentiator would be the valuations. In this chart, I plotted the the enterprise value over gross income for the three companies in the last 8-9 years. So for Amazon, its EV over gross income has been lower compared to Google and Microsoft in recent years because those two companies are more profitable as a software business. I think it's more meaningful to look at the valuation levels in each company's historical range instead of comparing one company to another because they are not directly comparable business. So at the current valuation level, Amazon's EV over gross income is within its historical range. So I would say it's fairly or undervalued given that its gross margin has been higher compared to the historical numbers. For Google, its EV over gross income is higher than its historical range, so it may be overpriced by 10 to 15%. Microsoft is very hard to value because of the transformation happened since 2014 to 2016. So I can definitely say that before 2018, it's undervalued since it's enjoying higher and higher return on invested capital. That means there are good investment opportunities ahead. So there are a lot of upsides, but it's difficult to predict what exactly Microsoft will invest in. If I've been conservative, I would say a 15% reduction to Microsoft and Google's stock price will give me the true market value. And if I combine these three companies, then I can conclude that 14% of S&P 500 may be 8% overvalued. So that's not a large number to warrant a crash talk. Of course, one can argue that there are other companies dramatically overpriced them, for example, Tesla or Apple. However, I can at least conclude that compared to year 2000, the entire market is not really extremely rich valued. So it's different compared to the big bubble in year 2000. As a result, I don't expect a big burst and a crash like what happened in year 2001 and 2002. This concludes this episode of Quest for Twice. Until next time, happy investing.